and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager and Partner at LLC Private Wealth. Thanks for joining us this week for our tactical portfolio update, where we talk about everything that's kind of going on in the portfolio, the markets in general. And today we're actually going to take a bit of deep dive into private equity or private debt funds, or sometimes called alternative funds. I'm going to touch a bit on that at the end, so stick around for that. I've been getting a lot of inquiries about it, and there's some things that I think a lot of people need to know about them before they run out and invest in it. But with that, let's take a look at the markets this week. So this week we have seen a bit of negative trend in the markets. Most of it is from the overhang or the pressure of the U.S. debt ceiling negotiations, concerns, I guess, over the U.S. going into default, and of course, the story for the last 12 months: inflation and interest rates. What's happening with those as we see more numbers coming out for the month of April, and kind of what we're seeing in May here. But overall, the markets have been a bit negative this week, giving back some of the earlier gains. That being said, we did see some of the earnings numbers come out. One of the big movers today we saw is in the tech side of things. NVIDIA stock rose almost 25%. Been a great success story, really, for the last 12 months or so. NVIDIA showed to be a leader in the chip making sector of the markets, and it lifted a lot of tech companies today in the markets, driving up the NASDAQ into positive territory and lifting some of the other ones, at least the other indexes. Mainly, it's been kind of centered around their success in their products going into all this AI development, as all the big players are jumping into AI with, we've all heard ChatGPT, Google jumping in, and everybody else who can is. So the chip manufacturer had a really good day. On the flip side of that, we saw companies like American Eagle come out with their earnings not meeting expectations. I saw a 20% drop in their stock today. So there is still two sides to the markets out there. There's still a lot of negativity, especially around consumer discretionaries like the clothing and retail areas, where people are cutting back their spending as they face higher cost of living and higher cost of borrowing out there. On the dollar side, the US dollar edged a bit higher. Not a surprise. You've heard me say it many times before. When there's negativity in the market, dollar goes up. Flight to safety trade. So we saw it go up a little bit. We saw the euro and US dollar fell slightly as some positivity over in the European side of things. And the pound actually had a bit of a lift today after some higher than expected inflation numbers in the UK kind of came out and they'll likely raise their rates. On the oil front, oil edged slightly slower, but still up for the week after some earlier gains on some positive inventory news. We have lightened oil in the portfolio. Recently taken advantage of the run-ups especially over the last year. It's been a great trade. That's not necessarily a negative outlook on oil, simply that we are more of a flattening of the opportunity there. So we're not as bullish on the upside of oil from here, but not saying it's necessarily a downside, but we have lightened the position in there. On the metal side of the thing, we saw gold slightly weaker, but not much, and that's just on the uncertainty on the debt ceiling negotiations as that continues to drag on. As I mentioned, NVIDIA had a great earnings numbers come out. The stock has done really well. Not one to chase those types of that type of momentum, especially buying the brand name. It's kind of we always like to try to find the old analogy. Don't buy the golds. If gold's running, buy the company that's making the pickaxe that's servicing it. So, one of the companies we're seriously looking at is a company called Taiwan Semiconductor, and they make all the all the chips for NVIDIA that are going into the AI products. So it's an interesting side play. the bit more diverse. We do have Celestica in the portfolio, which is a board builder. So again, playing in that space right now, and it had a great day today, almost up 5% as well. So it's continuing to move on. Down in the U.S., of course, we are seeing things ramp up for the next election with Ron DeSantis, throwing his hat into the ring, and will be running for the Republican up against Trump for the Republican nomination. So we get to spend the next almost 2 years watching that unfold. So that continues on. Some volatility out in the market. I did a video about a year or so ago on SPACs, or special purpose acquisition corporations. I'm not a fan of these. If you've watched the video, go get more details exactly of what they are and why I don't like the structure. They're suffering badly right now. They have been for the last year. They had a big run in 2021, but 2022 and 2023 they continue to suffer. And the banking crisis, the regional banking crisis in the United States, has not played out well for them, and we're seeing some now go into bankruptcy. So that's continuing to play out down there as well. As far as overseas, as I mentioned, Europe doing a little bit better. Italy seems, the markets there seem to really like their new prime minister. She seems to be more moderate than originally thought. Not as much as a hardline as everyone expected. So the market's been reacted positively to her management of the country. And we also see Germany doing well. They did actually declare that they're in a recession, but the markets acted positively as they see that as kind of old news, and moving forward, the recovery hopefully looks like probably a soft landing, which is actually a pretty good indicator for the North American markets. A lot of people are worried about the recession word or the concept of being in recession, but really, the way you calculate being in a recession, by the time we actually say you're in a recession, you're likely near bottom, or maybe even turning the corner, coming out of it by then. So not anything we're really afraid of. In fact, when we look at what's kind of overhanging the markets right now, I mean, the two big things that we're seeing is, of course, this debt ceiling negotiation. It's something's going to happen. Obviously the Republicans have done this before. They use it as a negotiation tool. Chances are there's going to be a deal, 11th hour deal made, and everything will be avoided and everything will be fine. If it doesn't happen and they go into default, obviously there's going to be a knee-jerk reaction in the market, but things will get repaired. It won't go on, right? Things will get negotiated out and moved on. So if anything, this negativity from that particular issue, presents more as opportunities than necessarily concerns. On the other side of things, the big overhang, which has been for over the last year now, is the inflation and interest rate outlook. And really, that's kind of a non-issue in the portfolios as well, because when we look at it, sure, there may or may not be another interest rate hike, or maybe two more interest rate hikes, but we're near the top. We're near the end of this cycle, or the inflationary cycle. So that means at some point, we don't know when, it's going to reverse, right? We'll start to see cuts or a softening of the interest rate environment, and that's going to be positive for the economies and positive for the portfolios. So, at this point, obviously, the risk of it continuing longer is less than the risk of it starting to reverse, or the opportunity of it starting to reverse. So that's our outlook, and that's what we're playing in the portfolios. And really, the companies that we're focused on the portfolios, as always, very cash flow strong, increasing yield, increasing dividends. We're looking for that growth. These are companies that we feel are strong in any markets, although the stock price might fluctuate a little bit, but we're very confident in the outlook of those companies and how they're going to perform. Now, before I let you go today, I'm going to touch a bit on this private equity, private debt stories out there, because there seems to be a million of them popping up. The story about alternative investing. It's been around for a long time. For a long time they were called hedge funds, private debt funds. They rebranded years and years ago to alternatives. And then there was a few 2 or 3 years ago, we had the change where they were a bit more called liquid alts, becoming more and more popular. So I'm not being negative on these. I'm going to explain why I have concerns about them currently, but not that I'm negative and not that they shouldn't be in a portfolio. They do offer a diversification beyond markets and beyond normal fixed income investments. But there are a lot of things you should know before you put money into them. So first of all, most of them are fairly illiquid. Even some of the liquid alt versions are better. They're better as far as liquidity thing goes. You do give up something when you ask for the liquidity, because of course the managers can't own things or can't own as many illiquid positions that supposed to be the specialty of these funds. They have to be able to liquidate out for you in a day. On that side of things, most of the the bigger ones or the ones you hear about more and more and more are less liquid, and that could mean 30 days to get out. It could mean 6 months. It could mean a year. I've seen some that have been multiple years that you can't get out of them. So liquidity is something to keep in mind, not just if you need that money or you need access to that money, but if the macro look in the markets or the macro view of the space that you're invested in is changing, and you can't change or adapt your portfolio accordingly, right? So, if you think that debt is headed for massive defaults, and you're in a private debt portfolio that you can't get out for 6 months or longer, you can't adapt. You just have to sit there and wait. You can ask to get out, but the price you're going to get out at will be 6 months from now, and it's completely out of your control. So always look at what your liquidity dates are on those things. The second thing that is a bit challenging and you should really aware of is you don't have a ton of insight into the portfolio. They'll give you an idea of what they're shooting for and maybe what they currently in the portfolio, but as it changes, you don't see those changes. One of the features of these types of investments is that they don't report back as often as normal portfolios do. So you might not know what's going in there at any time, and it can be changing. And I'll talk about the debt ones, particularly right now. One of my big concerns about them right now is there's a lot of new players popping up in this private debt alt fund market, and one of the big challenges with that is they're fighting for the quality, right? They want to, as they get money in, they want to place it because of course they want it working for you, and they want the returns to come in. But as it's in there, as there's more and more competition, there's more and more people fighting for the quality debt. So what ends up happening is people the managers to place that money, they have to take less quality or lower quality in order to achieve that. The other thing to keep in mind on particularly on the debt side of ones, they'll often come out and say, here's the amount that we're paying, 6%, 8%, whatever the number is. First of all, that's not guaranteed. That can change, and they have changed many times as the markets evolve. And again, depending on your liquidity, you can't get out that easily if it's locked in for a period of time. But also, take a look at that number that they're promising. I've seen some recently, saying, "Hey, we pay 8%." Okay, great, but there's fees that they charge inside the funds of at least 2%, sometimes more. Sometimes there's bonus fees or performance fees that get paid to them, and be very careful about those. They can be very costly to you. But if they're trying to give you 8% after they've paid all the costs and everything else, that means they have to get 10% or higher. So what quality of lending are you doing where you're getting 10% or higher? Obviously, some of it might be good, but it's only bringing in, say, 5, 6, 7, and they're turning around and trying to get this higher quality or this higher number through lower quality. So you do have part of that portfolio is obviously taking on some risk in order to give you that yield. So keep that in mind when you look at it, because when you tie that on top of the liquidity issues, I find you have to be very careful about which players you're doing, how they vet their debts or their investments, and if they are at all, because some of them contract that out to third-party debt managers, in which case you might not have any insight into what their controls are, what type of debt that they're doing, and you're taking the risk, right? I mean, if things go down, if things go negative, that's going to reflect back to you, the unit holder, not anyone along the chain. So that's a little bit to keep in mind. On the equity side of things, the private equity side of things, or the alts, equity alts, really look at fees, especially the performance fees. You want to know what you're getting into, why. Don't get brought in or impressed with past performance. Look at it year by year. Don't look at the average, because you want to see how volatile they are. Are they taking extreme risk? Because a lot of them use leverage, and in good markets, when everything's going up, sure, they go up, and they go up more because they're leveraged. But in bad markets, because they're leveraged, they go down more. So just be careful with your volatility and the risk in the portfolio. And remember, these things should be a portion of your portfolio. Should not be a substantial. It should not be. I've seen some recently advertised it should be 40%. I think that would be very high for me to be in alts. It's fine. We've had them in the portfolios before. 5, 10, 15% weightings. Even within that, diversified in between a few. But the reason I kind of bring it up, I've recently been working with one client that was 100% in it. In one particular portfolio, they were 100% into one of these things, and obviously between the liquidity, bad performance on it over the last couple of years, and being all in one, they handcuffed to some challenging performance over the last little while. So really keep that in mind, and that's the same on the equity and the debt side. So that's all I'm going to cover on that. I'll probably do a deeper dive into alts in the near future in one of our Mike on Money episodes, but I want to leave you with that. So with that, thanks very much for joining. As always, if you have any questions, any topics you want us to cover, go to mikeonmoney.com. Love to hear from you. Also, give us a call anytime. Happy to chat, answer any of your questions. With that, take care, everyone. Talk to you soon.